Yeah, well, that's the concern. On the flip side, people are pointing to earnings that have been incredibly strong as well as cash flow that is ongoing. Jim, how do you even gauge the strength that we're seeing in equities? What's your compass to know whether it's gone too far?
Well, it certainly isn't valuation. You're right. Earnings have been great, but boy, you're paying up big for those earnings right now. Some of the highest valuations we've seen in the market, and as long as it keeps delivering, you can push that aside. But I think the compass is going to have to be flows. I mean, we look at the flows into the market, and remember that almost all of the flows are going into index funds, and the majority of those flows are going into indexes tied to the S&P 500. So even if you look at a chart of the S&P 500, it doesn't look at all like the Russell 2000 because it doesn't have the index sponsorship that the market has. So every day investors come in, they talk to each other on social media, they develop a narrative, and they all plow into index funds, and we keep going. And only something that upsets that, and maybe that's the Fed or maybe it's something else, it's going to change it. But right now, that's not happening, so we just keep going.
All right, well, Jim Bianco, then weigh in here. If you agree with this, and please weigh in if you do not or if you do, this idea here that riskier assets, and I'm thinking of equities, I'm thinking of high-yield credit. These are some of the areas that people have pinpointed as possibly benefiting more from Fed largesse. Do you think that they are poised for some sort of pullback that is more meaningful than people expect should the Fed taper sooner?
No, not on the taper, but I think the Fed might have learned their lesson from December of 2018. That's when the last time they did the taper, and Powell used the words automatic pilot, and it'll be like watching paint dry, leaving the market with the impression that it's going to happen. It doesn't matter what the data is. It will continue to happen. And the market freaked out, and 2 weeks later we got the so-called Powell pivot when he said, I'm going to be patient and flexible. So I suspect what you're going to see is they're going to say, we're going to taper, but here's 12 off-ramps. And anytime one of these criteria is met, we're going to take one of these off-ramps. And so the market will be fine with the taper, knowing that if something wobbles or something weakens, the taper's off. Just like last year when they stopped the corporate bond buying program, the market wasn't bothered with that because they knew the minute the corporate bond market wobbled, it would be back on. So as long as they leave these open-ended commitment to if something changes, taper's done, and maybe we even go back to even increasing purchases, I think the market will be just fine with the taper because they know that it will be data dependent as we move forward.
Jim, this is actually a really important point. How big of a wobble does it have to be for the Fed to respond?
That's a very good question. And what does it have to be? Is it the Delta variant? Is it a weakness in the economy, higher inflation, weak jobs, or maybe it's just a 5 or 10% correction in the S&P? I think those are all the off-ramps that the Fed will give us. And if any one of those are met, in some way that the substantial further progress gets downgraded to just further progress, they'll change their policy. But if they come out dogmatic, we're going to taper starting on some date in the future, and it's just going to happen, I think the market is going to have a problem with it like it did in 2018.
So with us, James Athey, Jim Bianco, and Gina Martin-Adams. Jim Bianco, I want to start with you. This question of what is getting priced in and how. We talked about the fiscal stimulus being positive for economic growth, but on the flip side, tax hikes being somewhat more negative. Given the statement that we heard out of the Senate this morning where they were talking about agreements on raising taxes for certain corporations, is your sense that it's being led by the moderates and will be substantially lower with respect to the tax rate than otherwise might happen?
Yeah, I do think so. I do think that all of the big plans that we were thinking we were going to get even a couple of weeks ago are drastically being scaled back. And if we want to go political for a second, President Biden's approval rating has really been taking a hit the last couple of weeks over Afghanistan and COVID. And if it continues to fall and stays down, he's going to have less political clout, which means an even bigger scaling back of whatever plans that they have moving forward. So the market may have been thinking that there was going to be big tax hikes and big spending coming, and now it's probably dialing that back a little bit to lesser tax hikes and lesser spending.
Jim, which raises a question. How do you hedge, and is it worth it to even try?
Oh, it's a tough one to hedge because if you look at the normal hedge or the traditional hedge, which would be interest rates or the bond market, the correlation between that and stocks have fallen to approximately zero over the last several months. The 60-40 portfolio isn't behaving like it should, but no one cares because stocks are going up and bonds have rallied the last few months. So it's the 100 portfolio going up. So I don't know if you can really hedge at this point other than just, lower beta stocks or maybe just looking to run to the exits at some point. That's going to be a tough one. So it's really just a bet on whether or not the stock market's going to keep going up.
There really is a question of what a safety is or whether this is the new world that we're living in. Still with us is Gina Martin-Adams, James Athey, and Jim Bianco. And Jim, there is a question as we take a look at some of the structural changes in the economy, how much they are being priced in. Some people saying that actually productivity is staged to increase dramatically because of the tech influence. Where do you fall on this front?
Oh, I definitely think it's going to increase. I'm in the camp that this whole work from home experiment has been a success. It has increased productivity for a lot of people. And let me be clear, we're talking about maybe 30 or 40% of the jobs in America that are basically service sector jobs or information jobs where you spend most of your day in front of a computer. You've eliminated the commute. You've given people their jobs more time. And I think that this whole kind of hybrid system, if not remote work, is here to stay. We're just kind of trying to sort out which way it's going to go. Unfortunately, some of the big financial institutions don't see it that way, and they're desperately trying to get everybody back to the office 5 days a week. I think that they're fighting a losing battle on that. So I do think that productivity has taken a jump higher because of this whole remote work idea.
Still with us, James Athey and Jim Bianco. Jim, I'd love to get your take on emerging markets at a time when we do see dollar strength, and that seems to be the path forward, especially if the Fed is going to be the first to tighten. Is there this disconnect in emerging markets where people are perhaps discounting too much, especially with the dynamism coming out of China?
Yeah, I think there might be as well, too. I attribute first the dollar strength to it is the safe haven, if you will. When you see rising cases and you have more talk about the economy, the global economy slowing, the natural move would be towards the safe haven, the reserve currency in the dollar. And I do agree that while China has some problems and they have been at the forefront of really some, what we would in the West consider shocking news, like mandating education companies become non-for-profit or punishing companies for listing on the New York Stock Exchange, you're washing out to see a lot of the non-China companies like Brazil and India, as well as Russia. And so you're seeing that a bit of a disconnect. China is got issues, but let's not wash all of the EM out with it. And that might be what we're doing right now.
But how do you view the dollar with respect to that, Jim? If you look at a dollar that has been strengthening and a lot of people expect it to either stay where we are or continue strengthening from here, how do you play this?
Yeah, I mean, there's two different issues here. I think the dollar has been strengthening largely because, I believe, because you've seen a lot of people moving towards safety. They're worried about the global economy. They're worried about Delta. Now that I've said that, you also have with the emerging markets a bit of a mispricing. So those that are willing to take the risk, I think there is a potential for some really good rewards.
James,